Hi everyone! So in today's video, I want to upgrade my previous video on Yili Group after someone pointed out that the share price has corrected recently and asked whether at today's price the company could represent an opportunity. Let's start with revenue. Compared with 2024, revenue was almost completely flat in 2025. The number is practically the same, so there was no real revenue growth for the group during the year. The explanation comes mainly from the evolution of sales volumes. On the chart, we can see that total volumes were almost flat, but the interesting point is the mix behind this number. Compared with previous years, liquid milk volumes clearly decreased. On the other side, the segments that helped stabilize the group were ice cream, cold drinks, milk powder, and dairy products. So the basic product, liquid milk, is under pressure, while the other segments are starting to rebuild growth. And this seems to be the direction of the group. Less growth coming from the historical core product and faster growth from the other categories. This trend also continued in Q1 2026. Revenue increased by around 5% compared with Q1 2025. The strongest segments were ice cream and cold drinks, up 7.1% year-on-year, and milk powder and dairy products, up 6.1%. Liquid milk also returned to positive growth, but the increase was more limited at 2.3%. This shift is positive for Yili because these categories usually have higher margins than basic liquid milk. And we can see that in the gross margin charts. In 2025, the group improved its gross margin. We are still not back to pre-COVID levels, but the direction is encouraging. If this trend continues, Yili should benefit from a better product mix, with more contribution from higher value-added categories. Now let's look at earnings per share. EPS rebounded clearly in 2025 compared with 2024. I also added the amount of asset impairment losses for each year on the same chart, because it helps explain part of the decline in 2024 and also why the 2025 numbers improved. The improvement came from two elements. First, the gross margin recovery that we just saw, and second, a significant decrease in asset impairment losses. These impairment losses are recurrent, but the level in 2025 was much lower than in the previous 2 years, especially compared with 2024. As we saw in my previous video, the 2024 impairment mainly came from House Nutria, a company acquired by Yili to strengthen its position in infant nutrition. House Nutria had a strong position in China, but this market has become much more difficult because of lower birth rates and stronger competition. So in 2024, Yili had to reassess the value of its acquisition and book a large goodwill impairment. So overall, EPS improved clearly in 2025, and the positive trend also continued in Q1 2026, with revenue growth translating into earnings growth. EPS increased by 10.4% year-on-year. On the balance sheet, there is no major change. To make the chart easier to read, I added the cash-like resources that are outside the simple cash line. This gives a better representation of the group's current financial situation than in my previous video. And with this adjustment, we can see that the group remains solid from a balance sheet perspective. Now on CapEx, the chart clearly shows that the business has become mature. The need to invest is now much lower, the structure is already in place, the industrial assets have been built, and the group is now more focused on its existing business. So for the moment, the heavy investment cycle seems clearly behind us. On free cash flow, we can see a decrease in 2025. Intuitively, I expected free cash flow to increase, but working capital had a bigger negative impact this year, and this translated directly into lower free cash flow. For me, this is not alarming. It is mainly a working capital effect, and I don't expect this to weigh on free cash flow in the same way next year. Now let's look at shareholder returns. Linked to the good results in 2025, Yili decided to increase its dividend. The payout ratio is now back in a more normal range, around 70 to 80% of earnings. The very high payout ratio in 2024 was distorted by the goodwill impairment we discussed earlier. So at today's price, around 25 RMB per share, the dividend yield is around 5.5%, which starts to be interesting. On top of that, Yili has also implemented share buyback programs. The amount is not huge, but it still exists. It represents approximately 0.5% of the company's market value per year. On the regression chart, today's price, around 25 RMB per share, is not very far from the -2 standard deviation level from the regression line. But honestly, it is now a mature company, so I don't think this regression chart is the most relevant tool for this business. Still, it gives us an idea of where the share price stands today. And based on 2025 results, the price-earnings ratio is now much more reasonable, at around 13.7 times earnings. So, to conclude, as we saw with the sales volumes, Yili is now a mature company. It is also a defensive business because it is linked to food. And even if competition remains intense in China, the company still has a strong positioning. Yili is number 1 in China in liquid milk, infant milk powder, adult milk powder, and ice cream, and number 2 in cheese. So the group still has a very strong position in the Chinese market. The 2025 numbers and Q1 2026 results showed a more positive trend for the company. From a shareholder point of view, Yili can become interesting in a portfolio at the current price. I would put it in the same category as China Mobile. For someone looking for a business that can generate recurring cash flow, for example for retirement, it can make sense. I also like the food component. In general, food can be a good hedge against inflation, probably better than telecoms. Today, the dividend plus share buybacks represent around 6% of shareholder return. At this price, I think the return starts to become interesting. And on top of that, there is also the potential appreciation of Chinese yuan against the US dollar. In the end, it depends on your portfolio allocation and your investment style. If you are more aggressive, it is probably not the most exciting stock. But for the defensive part of a portfolio focused on China, at the current price, I think it's not a bad idea. Among the different companies I have covered, for example, a basket with Yili Group, China Mobile, Haidilao, and a REIT like REIT could start to make sense. Thanks for watching this update until the end. If you found it useful, feel free to like, subscribe, and share.